So good afternoon, everybody, and welcome to our new Dockland campus, the first press conference in our Dockland campus for the annual report and annual performance statement. We're joined today by Deputy Governor for Central Banking, Sharon Donnery, Acting Deputy Governor for Financial Regulation, Bernard Sheridan, our Chief Operations Officer, Jerry Quinn, and Governor Philip Lane. So we'll open with some opening remarks from Governor Lane, and then we'll go to questions.
Good afternoon and welcome to our new building. The annual report, the statement of accounts and the annual performance statement are the centrepiece of our framework for accountability. The annual report provides a comprehensive account of the fulfilment of our responsibilities and governance, the key activities and developments in 2016, while the statement of accounts gives a detailed overview of our financial operations and accounts. In addition, we also today published the annual performance statement on regulatory activities for 2016, which also includes plans for 2017. Let me address some aspects of each in turn. In relation to the annual report, the first chapter provides an overview of our strategic plan for 2016 to 2018, as well as outlining some of the desired outcomes in relation to our wide-ranging mandate. The strategic plan articulates how we aim to deliver on our mission to safeguard stability and protect consumers, as well as providing the benchmark against which the Commission measures the performance of the bank. Our activities span areas such as price stability, financial stability, consumer protection, supervision and enforcement, development of regulatory policies, payments, settlements and currency, the provision of economic advice, statistics, and the recovery and resolution of financial institutions. The third chapter of the report gives more detail about our governance arrangements, such as the structure of internal committees, the key responsibilities of each committee, and attendance records by members of the Commission at these various subcommittees. And by elaborating on these factors, we think it facilitates enhanced transparency to the public in keeping with our commitment. The annual report also gives an update on key activities and developments in 2016. Let me touch on some of these. First, ensuring that the best interests of consumers are protected is a core part of the bank's mission. The tracker examination is one of our key priorities and is the largest, most complex supervisory review undertaken as part of our consumer protection mandate. A lot of progress was made in 2016, and I think that will be brought to fruition for many affected customers this year. And we recently published a comprehensive update, including our principles for redress in cases where losses were made. Our priority is to ensure that lenders carry out a full review and they ensure all affected consumers are appropriately redressed and compensated for the harm caused to them. We are committed to taking the necessary supervisory action, including enforcement action, to ensure that lenders deliver fair outcomes for all affected consumers. And we will publish a further update in the autumn, and a final report will also be published upon conclusion of the examination. Second, our macroprudential powers allow us to deploy a suite of measures to mitigate systemic risks. These include the mortgage measures, which aim to enhance the resilience of both households and banks. In 2016, we completed the first review of these measures, which examined their performance against our stated objectives, as well as assessing possible side effects. The review found the overall framework to be appropriate and effective in meeting these objectives. However, some revisions were introduced last November to improve sustainability and effectiveness. And in line with our procedures of an annual review, the next review will take place November this year. Third, while the domestic economy continues to improve, external risks remain significant. These risks include those relating to Brexit, but also the risks associated with any increase in global protectionism or elevated levels of risk aversion in international financial markets. Prior to the UK referendum, a Brexit task force was established here in the bank, and it continues to assess and analyse the implications, including the potential of a more diverse range of firms and business models requiring the bank's authorisation and supervision. We will ensure that any entities seeking to locate in this jurisdiction will be substantively run from Ireland. While we have considerable experience in dealing with authorisations of large financial firms, we also have set up new teams to deal with the expected increase in the volume of applications, and we are satisfied we have calibrated our capacity to deal with both expressions of interest from firms to substantive discussions regarding authorisations. Fourth, in 2016, the IMF reviewed Ireland's financial system under its Financial Sector Assessment Programme, the FSAP process. The FSAP found that the Irish financial system has strengthened significantly since the crisis and has undergone major structural changes. While recognising the considerable progress made in the quality of supervision and the capacity of the system and authorities to manage and resolve crises, the IMF noted that vulnerabilities remain. In addition, the global scale of the international funds industry in Ireland was also noted, with recommendations that the bank continue the supervisory innovations, collaboration with other agencies and data monitoring already established in this area. Next month, our macro-financial review will update our assessments of risks and remediation on vulnerabilities across the financial sector. The bank is committed to providing regular public updates on our assessment of risks and vulnerabilities. These are also captured in the publication of our meeting accounts of our Macroprudential Measures Committee and the meetings of the Central Bank Commission. Today, the annual report also publishes our statement of accounts. We are reporting a financial profit of 2.3 billion in 2016. After retained earnings, the surplus income which will be paid over to the Exchequer amounts to about 1.8 billion. The bank's profits continue to reflect the legacies of the crisis, both domestically and in the euro area. These factors will diminish over time so that the bank's profit flows will normalise to more modest levels. The current high profit levels are primarily driven by the interest income and realised capital gains on the special portfolio that was acquired as a result of the liquidation of IBRC. So that component contributed 1.9 billion to the 2016 profit numbers. The Central Bank has stated it would dispose of the government bonds held in the special portfolio as soon as possible, provided conditions of financial stability permit. It follows that these high profit levels will decline in future years as disposals of the special portfolio come to an end. Furthermore, a general assessment of financial risks has identified a potential interest rate mismatch related to the purchases as part of monetary policy implementation of low interest rate instruments in recent years. Considering this risk, the bank has prudently chosen to set aside a provision of €165 million in its 2016 annual accounts. The provision has been established to cater for the possibility of such mismatches arising. Thank you. We are now at your disposal for questions.
Thank you. And may I just ask, if you have a question, just to raise your hand and wait for the microphone to come to you, because the session is being recorded. And we'll start with 2 questions per media outlet, and then with time, then we'll come back around to everybody again. So may I invite questions, please? Okay. Perfect.
Colin Kelpie from the Irish Independent, Governor. Hello. Can I just ask, in the section on expenses on page 127, you make reference to a payment of €33,000 for a redundancy payment to one contractor last year. Could you elaborate on that, please? Thank you.
Let me ask Jerry Quinn to take that question.
So in relation to the issue on page 127, yes, this was in relation to the expiry of a fixed-term contract, and there was a statutory requirement to pay that redundancy. So this was an individual that was taken on for a specified purpose contract that extended beyond the 2 years. Once you go beyond the 2 years, you then get certain statutory entitlements. So it was simply a follow-through of a statutory entitlement. I'm not sure of the specific area that they were working in, but I mean it just follows through in relation to following through on what we're required to do from a statutory point of view.
Okay, I have another question. Vincent Boland from the Financial Times.
Thanks, Governor. In relation to profitability, how much more profit would you project that the bank can make out of the IBRC portfolio, and when will the decline to more normal levels begin? I mean, is there another year or more of exceptional profits to be made?
We really can't predict the future path of disposals. What you've seen is that the pace of disposals has been significantly above the minimum levels that were outlined at the time of the 2013 liquidation. At the same time, it's also the case it's at a fairly measured pace. So the speed of disposals is going to depend on a range of factors, which we've captured throughout in how we think about it, is that the disposal it's important to make the disposal subject though to conditions of financial stability, which, as you know, can vary for all sorts of reasons. So it would be, I think, not a good idea to give a fixed forecast. But what is true is that at some point they will come to an end, and at that point we're going to look much more like a normal situation.
What is the normal level of profitability?
Let me say there's a second factor currently now also with the asset purchase programme, because of the fact that the European system is committed to buying assets as part of monetary policy. The balance sheet is bigger for that reason also. So that factor also over some period of time will not be moving in the same direction. So I think there's two factors which mean the current situation is not, if you like, normal. But the most basic calculation you can make there is we've said that the profit level is 2.3 billion, of which 1.9 billion relates to the special portfolio. So the remaining, which I wouldn't classify as normal, but maybe closer to normal, is 400 million.
Okay, Dara Doyle from Bloomberg, please.
Governor, can you explain to us again how the central bank makes profit on the special portfolio? I used to understand, but I've forgotten.
Sure. There's two components, and it's important to say these are the central bank profits. Of course, from the point of view of the state, in terms of a wider sense of what does it mean in terms of the overall calculations, is that the interest income, these were fairly high interest rate bonds because they were struck, if you like, in early 2013 when the Irish government, if they went to the open market, was paying a pretty high interest rate to if they had tried to raise money at that point, it would have been at a high interest rate. So part of it is on the bonds we hold, we receive interest income from the government, and essentially that's flowing back to the government because the interest income is part of the profit. The second element is, of course, in a low interest rate world, the market value of these bonds is high, much higher than at the time of acquisition. So when there's a disposal of these bonds, when we sell off these bonds, then there's a capital gain, which then again is returned to the state. So those are the two elements of the accounting treatment, but it's if you like the central bank accounting view of it.
But the NTMA pays higher market price.
Exactly. So, but it's also important to take into account the NTMA currently is able to fund at very low interest rates, and if you like, let's see 25 years or 30 years from now about the calculations, because I think from the wider public finances point of view, question in terms of the NTMA's interest in buying these bonds, you'd have to ask the NTMA, but I think our view of the world is that the current low interest rate world won't necessarily last forever. And the ability of the NTMA to refinance, if you like, at low interest rates compared to the high interest rate environment of 2013 is part of the calculation here.
So it's 1.9 billion of the
2.3.
links and things.
Yeah, yeah.
Okay, Padraig Halpin from Reuters, please.
Governor, just a quick ECB-related questions. Just looking forward to the meeting in June. Should the ECB drop the references to downside risk or easing bias at that meeting? And just on a couple of data points, there's strong GDP out today, and there was inflation figures on Friday that were very, very strong as well. What are the implications for those in your thinking?
Well, I don't think it would be a good idea to, 1 week after the most recent monetary policy meeting, to start jumping ahead to the next monetary policy meeting. What is true, of course, is that June will have a new forecast, and as you say, the kind of the news that arise day by day about certain numbers will be factored into the forecast. So I look forward to reading what the European system forecasts in terms of inflation and GDP. When we get those updates, of course, that's relevant. But I think if you listen to the press conference last week, I think Mario Draghi conveyed the views of the General Council, which is it remains the case that the current accommodative monetary strategy, it's important to maintain that while we have inflation well below target. We have to assess at what point will inflation be clearly on a sustainable path towards the target, and until that day arrives, the current strategy is in place.
Okay, the next question for Vincent Wall from News Talk, please.
Just following up on Dara's question, Governor, I was very disappointed that he couldn't remember the process, but seeing as he asked, is it fair to say, I mean, obviously this is a central bank accounting process here, but is it fair to say, given the interest paid by government goes back as profits, or some of it, and that the NTMA buys the bonds for you in a holistic exchequer or state level, there's no surplus being generated in response to the IBRC's situation?
No, I don't think that's correct either. It's going to be a case of calculating at what point will interest rates go up again. Because right now, essentially, it depends on, at some point, these bonds will mature. So let's say we held on to these bonds until maturity. At that point, the NTMA would have to refinance this debt, and what would be the interest rate at that point? We know interest rates are low now, at least by historical norms. And so if the Irish government can fund itself at fairly low rates at the moment, that is the forward-looking calculation. Is it better to refinance ahead? I mean, the NTMA all the time is managing the national debt. It might retire a given maturity and replace it. And that's up to the expertise of the NTMA to work out. What is optimal. I mean, they have their job to do, we have our job to do, and their calculations has to compare the refinancing cost now versus taking the risk of waiting until the bonds mature before refinancing. So there is a genuine economic issue which the NTMA has to grapple with, but I think the core of it is now versus later, and given interest rates are low now, that's a material issue in deciding whether they want to buy up these bonds.
And the second is a totally separate issue. Is there a timeline at this stage in terms of the administrative sanction process against the former Irish nationwide executives and board members?
The process is live. But that this case is complex. There's a lot of documentation. And the inquiry has to do its job. We can't really, as with any procedure, it's really hard to forecast in advance how long it's going to take. But there's a lot of effort going into making that process work. But I can't give you a timeline on it.
Okay, the next question is for Peter O'Dwyer from Times Ireland, please.
Governor, you mentioned in your remarks that you were satisfied with the capacity of the bank to deal with the level of applications and authorisations that were coming via Brexit. Can you just outline how many staff have been allocated, I suppose, to deal with those applications, if you expect that staff will have to grow over time, and how many vacancies there are just across the bank generally at the moment outstanding?
Let me talk about how we're handling Brexit, and I'll ask Jerry Quinn to talk about the overall vacancy issue. So if you like, we've got maybe three levels of engagement with Brexit. First of all, it's a big priority for large parts of the bank. So the senior management of the bank, across many dimensions, are dealing with Brexit-related issues on a day-by-day basis. So it's a bank-wide priority, and a lot of, if you like, man hours and management hours are going into that. Number two, in some areas there was earlier indications than others about how many authorisation requests would come in. So we had at an early point at the end of last year, we made specific provision for extra hiring in those areas in relation to Brexit, and we announced at the end of last year there's going to be about 28 extra jobs. And then as we go along, what's going to happen is if we see a more kind of concrete realisation that a given firm is going to seek authorisation, then we will, on a contingency basis, at fairly high frequency, decide we need extra staff to take on this extra workload. Let me emphasise, it's not the case that this, for an important authorisation, we're waiting for new staff to arrive. But what's true is, given the overall workload would be going up, given that our more experienced staff will be leading the work on important authorisations, there'll be an element of backfilling that, for those people to be pulled into important Brexit-related work, other people need to be brought into the organisation. So, I think it's this kind of approach is fairly calibrated, and I think, as we said in the statement, we think it's going to be okay. Sorry, Jerry, on the overall vacancy issue.
In the overall situation, we've just over 1,600 full-time equivalents at the moment, and we're aiming for approximately 1,800. So at the moment, we have in the region of 175 to 200 active vacancies.
And do you have time frame as to when they will be filled by, or you want to have them filled by?
Well, it's an ongoing process in terms of filling those. Last year, we had a net increase of about 83 full-time equivalents in the organisation. That was added to about 150 of an addition to previous years. So we've grown by over 200 over the last 2 years, and our agenda is to grow by that additional 200 over the coming months.
Another question from Colm Kelpie, Irish Independent.
Governor, just following off Peter's question, you make the point in the report that the retention payment policy, there are no further payments due under that. Does that mean that policy is now ended? Or would you like to see a policy like that continue? Because Cyril Roux makes the point in your internal interview that there is still an issue retaining and attracting staff. So is that an issue in your view, particularly in the context of Brexit? Thank you.
It's not a current issue. So the policy exists, and the policy is pretty specific. So there's a range of criteria must be met before a retention policy will be triggered. But it's a natural part of dealing with that situation. So there's no current. Since I've arrived, there's no current new cases. But as you point out, with Brexit, maybe there will be situations in the future. I don't know. But I think it's a natural part of the toolkit to have a retention policy. Well, I mean, I think you see this across not just the public sector, which of course we live under the public sector pay policies, but in the private sector also. Given the economy is doing so well, given that employment is growing quite strongly, many firms and many institutions do have to deal with vacancies, do have to deal with retention issues. So it is a management challenge. But I think, especially in a capital city, I'm fairly sure it's also the case for regulators in other financial centres. It's just part of life to deal with that problem.
Vincent Boland again from the Financial Times.
Governor, how many institutions have approached the Central Bank for authorisation to operate in Dublin since the Brexit referendum, and how many have you authorised?
So we did, discuss, what can we say about this? I think it's not useful to say, here's the number, because you can have very marginal inquiries, like a phone call or something. You can have really substantive engagement. You can have a collection of small firms, which are not really going to move the dial in terms of the Irish financial system. You can have other firms which are quite significant, which if a small number of those firms arrived, would be quite important. It remains the case, I think, by and large, you will see yourself as these firms report on their own thinking. It remains the case many firms have yet to enter a decision-making mode. They're still debating the pros and cons, I think, of different locations. So let's see what happens. But we are, discussing Brexit-related issues with a wide range of entities across a broad range of sectors. But these firms, as they make decisions, by and large, these firms will indicate what their plan is.
Any further questions? Dara Doyle again from Bloomberg.
Standard Chartered today said they were choosing Frankfurt over Dublin. Are you disappointed with some of the decisions that have been made by firms, particularly around the insurance sector? It seems we've lost out on a couple of big ones. AIG, for example, would have been an obvious contender to come to Dublin. Obviously, you can't discuss specifics, but in general, any disappointment around some of those decisions?
I think throughout, my aim has been to make sure that regulatory issues essentially do not play a role in these decisions. Firms have all sorts of factors to consider. I think throughout the European system, and I think a lot of what you've seen is essentially a determination by the entire European financial system that there is a level playing field, more or less, maintained. So as firms make decisions, my ambition is to see that these decisions are made on non-regulatory criteria. It is a single financial system. Ireland greatly benefits from having a single European financial system. And so our responsibility is to make sure that within that we are trusted, we are seen as a reliable and trusted regulator, which is doing no more and no less than implementing the broad European regulatory framework.
Owen Murphy has talked about the possibility of regulatory arbitrage. So do you disagree with him that there are other cities undercutting Dublin with being more loose around their rules and regulations? I know not around banking, because you can't do it around banking, but around other sectors in particular.
I think we'd have to wait for more decisions to get, if you like, enough of a caseload to work out whether that is a substantive issue. Because, of course, it's tempting, if you read about any individual firm, it's tempting to infer that decision is driven by every possible factor. So I think there's a determination, not just in banking, but across the broader supervisory system, to minimise the role of regulation in this process. What is true is that regulation in some areas can be complicated, and there could be genuine differences of interpretation. But I think there's a lot of exchanges within the regulatory world to try and come to, as far as possible, a common view, a consensus view about this is what regulatory expectations should be in relation to Brexit. And we saw, in relation to banking, the SSM quite recently put on their website, basically a Q&A about, and I think we will see more of that.
Okay, question of Niall Brady from the Sunday Times, please.
So just on the Brexit issue again, Sylvia Cronin some time ago was able to talk about figures in broad terms, and she mentioned, I think, 20 insurance applications that were in the pipeline back then. Can you not give us some sort of an update even on those 20 applications?
At two levels. Number one is probably insurance. It turns out maybe more firms were ready to make decisions earlier than in other sectors. And as you know, we have a large insurance sector here. But it's very much the case that we don't, have a continuous feed about here's the state of play. I mean, the authorisation process is an interaction between the firm and the regulator. I think every 6 months we have
Yeah,
a
I think the
regulatory
next one is
report.
out the end of July, so we have authorisations including fitness and probity applications as well. So that end July report we can share with you. The question there from Vincent Boland from the Financial
Governor,
Times.
is it likely that Dublin simply doesn't have the heft to be a serious competitor for post-Brexit business fleeing the City of London, and that the lack of housing and the infrastructure problems and the smallness of the financial services industry in Dublin are serious handicaps to the attraction of new business into Dublin?
I think from early on, when I've thought about Brexit, I've pointed out that there's no replacement for the City of London. London, if Brexit is Brexit, London is London. And every location, there's not going to be, I think, any one location which is going to become the alternate London for the EU 27 or for the Euro area. So I would think that there's a range of factors influencing how firms make decisions. Common factors like housing, infrastructure, tax systems, legal systems, and every firm has its own unique history, its own unique set of linkages to different cities, and I think all of those factors come into play. So it's not my impression that Dublin is not in the mix. As I think. What we're seeing is Dublin is being compared to various other locations in many cases. So, let's see as firms make final decisions what the pattern is in the final configuration.
Okay, next question for Pádraig Halpin from Reuters, please, and then the Irish Times afterwards.
Just actually two separate questions. Just on the Brexit firms, just from your conversation you're having, do you have any indication of when those authorisations or kind of a rush of them might come? Is it sort of towards the end of this year or closer? And just separately, there's been a lot written recently about the poor statistics around housing supply in the country. Just wondering if you're concerned about that and I guess where you see house prices, or do you see them staying in double-digit figures for the foreseeable future, given the lack of supply we're seeing?
On the first, now that Article 50 has been triggered, I do think many firms are entering a phase of, at the very least, narrowing down their options, and I think in more cases actually making decisions. So my prediction is that yes, the rest of 2017 will see a lot of firms move into decision-making mode. On the second question about the housing sector, let me emphasise is that, and this is reflected in our assessment last year, is the Irish housing market has been so volatile because you had the gigantic boom, you had the massive crash, and then you've had a kind of a type of recovery in recent years. But that type of recovery has seen very low transaction volumes when you know already that the supply of new housing is quite limited. But the turnover of existing homes, the normal life cycle of housing, trading up, trading down, all of that has been very low as well. So, in that context, when you see a movement in house prices over a short period of time, it's very important not to extrapolate from that. Because, if you like, there could be all sorts of step adjustments as, with strong employment numbers, with the interest rate environment, and so on, is you can have, revaluations of where the level of house prices should be. But I think the important feature from our point of view is our mortgage measure framework has a lot of self-fulfilling breaks in the system. So the loan-to-income ratio means it's difficult for house prices to climb persistently if incomes do not rise in the same way. Because the 3.5 times income ceiling on a mortgage means that as house prices go up, the cohort of households who can meet that condition shrinks. It does reinforce the affordability issue because house prices might rise relative to average incomes, but it means those who are buying, if they're meeting our criteria, which is a fairly tight criteria, say, compared to the UK, that 3.5 times income is a, and then our kind of percentage deposit requirements. One category is first-time buyers, which is 10%, but a lot of the market, last year about half the transactions were first-time buyers, half were second-time buyers, trading up, trading down. And for those, the 20% deposit requirement remains unchanged. And the buy-to-let is a 30% deposit requirement. And as house prices go up, the amount of cash you need to fulfill those requirements goes up also. So there are kind of self-correcting features compared to what, this framework was absent during the boom period in the mid-2000s. So I don't think we can have the same dynamic as we had before because of the fact that those breaks are in the system.
Your next question, Owen Burke-Kennedy from the Irish Times.
Yeah, just on the same sort of issue, but the central bank's revision to its mortgage lending rules has been kind of criticised recently for fueling further inflation. Just like your view on that. And then is it your impression that we may actually lose Brexit-related business because of the infrastructural bottlenecks that currently exist?
On the first, I think it's important to emphasise a few things. One is, in a very positive economic environment, the fact that house prices are going up, is maybe not too surprising, especially given the fact that, there's still the adjustment from the boom-bust cycle we had. So where house prices should settle down, in terms of the economy, I think remains a genuine debate. Of course, the constrained supply issue is also very relevant. But let me zero in on the revisions to our rules last November. By and large, the rules were unchanged. The one revision was that for first-time buyers buying looking for a house value above 220k, there was this new requirement that instead of having to put down 10% on the first 220k and 20% on the balance, now it's 10% for the full value of the house. That is a fairly small segment of the overall housing dynamics. And it's also the case under the original framework, when we looked at it, and we published this last November when we released the review, a large fraction of households were putting down more than the minimum deposit, so they were unaffected by this change. Equally, a significant fraction were receiving exemptions. We had this exemption framework, so a certain fraction of the loans could be exempted from the rules. So the fraction of households which are being actually affected by this revision, it's not zero. It's definitely, I'm sure, part of what's happening in some slices of the Dublin housing market. But it's only a fairly small slice because it didn't affect the second-time buyers and the material impact on the size of the ability of households to borrow money. In certain cohorts, it's there, but for many others, it's not there. And remember, the loan-to-income ratio is still there to 3.5 times. So given all of the different conditions required to satisfy our rules, it may well be playing a role, but it cannot be the main source of what's going on because it's just the cohort of borrowers affected by that relaxation is fairly restrictive compared to the whole housing market.
Okay.
Sorry, your second question was Brexit
and infrastructure.
Oh, Brexit and infrastructure. I think many firms, if you like, what to think about now is 2 or 3 years from now. 2 or 3 years from now, will I have office accommodation? 2 or 3 years from now, will my workers be able to find schooling and housing? So there isn't, I think the window is tight, but it's not an issue about the current infrastructure. It's about, it's a mix of the current infrastructure plus projections about how quickly will some of these problems be fixed. Because, of course, Brexit is not going to happen for 2 years at least. The scale of firms will naturally be limited until Brexit actually happens. So there is some time, I think, to work on those issues. But of course, the primary interest in fixing these infrastructural problems is domestic. The domestic population want these problems fixed. Secondarily, of course, those looking to relocate would also welcome anything that improves the bottlenecks.
Thank you very much. May I invite any final questions? Niall Brady.
So just returning to the Brexit issue again, I mean, you mentioned, that regulation shouldn't be part of the decision as to where firms relocate to. But I think yet we've seen, say, AIG and Lloyds of London both would have referred to regulation as a factor in their decision making. And certainly within the insurance sector, there seems to be a perception that maybe other jurisdictions are more lenient in terms of the proportion of business that can be reinsured and how that's treated for capital purposes, and that Dublin has a much harder line on those issues.
Let me make 2 points. One is, I'm not going to comment on the motivations behind the firms' decisions by individual firms, so I have nothing to say on that. But as you mentioned earlier on, we did disclose that Sylvia Cronin did describe the fact that we have had a significant number of applications in the insurance sector. So I would not view it as a case as that the insurance sector is somehow viewed that we're viewed, I think, as quite a strong regulator. We have a lot of insurance activity here, so I think the evidence is there that firms are interested in looking for authorisations here.
Thank you. I think we've answered all questions. So if there's no further questions, thank you very much. We look forward to engaging with you in further questions, and we'll see you next month for the macro financial review. Thank you very much.